Welcome, welcome, welcome. Nice to have. Let's get everyone in the room. As I always love doing on webinars is, where are you coming from in the world? It's lunchtime somewhere in the world, certainly where Paulo, Chad, and myself are, but it's probably breakfast elsewhere and dinner in other parts of the world. So it'd be lovely to know where you are in the world, and let's let everyone get in the room and start to understand and update. It is wonderful, Chad, to have you back online. As I was joking with you before we joined, it's been a long time since we shared can't speak English. Long time since we shared a screen together. So I'm fascinated in kind of where the markets are at the moment and what your thoughts are and where we're going. And most importantly, starting off with where are our current deals, and I'm an investor in all the deals. So where's my money? What's happening with it in terms of the process? So I know Andrew's going to be joining us as well, which is fantastic. Without further ado, what I thought would be an agenda that we would run through is that we pretty much will get started. Chad will give us an update on where we're at with the current structured notes that we as investors through Wealth Migrate have invested in the deals, so we know where the current deals are. We'll then pivot to Paulo and myself in terms of understanding where we're at, some of the challenges we've had in terms of getting the money into people's wallets and what we're doing and what the timeframes are to get that sorted. And then finally, we're going to pivot to Andrew in terms of where is the world's a crazy place. I mean, we might have had an assassination on the weekend. We've had elections all over the world, so it'll be wonderful to know kind of Andrew's thoughts on where he sees, the markets going, where the opportunities lie. So that's kind of the context of how we kind of want to run this. So without further ado, I want to get started. I want to share my screen just very quickly with you, and then I'm going to hand to Chad. One of the things that we believe a lot is living up to our core values of trust, transparency, and alignment. And one of the things that we're wanting to do is to work with our partners to bring an update on all the different deals. So every single deal, what is happening, where we're at in terms of that process. We are trying to run an updated sequence. Again, we're not giving you financial advice, but it is important, we believe, that investors get access to communication and to their dividends. So we run this table, and I'm not saying this table is updated, but our idea is to be running this table and to be updating people which deals are performing, which deals are exited, which deals have challenges, and why they have challenges. And our commitment is to go back to the rhythm that we were doing originally. So again, to do weekly updates just in terms of what's happening, because things change fairly quickly. We've got an investor FAQ in general next Friday for everyone. And then we're doing these specific sponsor-related webinars with every sponsor. And Chad, it's as always, you are super efficient, more efficient than anyone else. So we are, getting started with you and Andrew, which is fantastic in terms of us understanding from an investment perspective. So without further ado, I wanted to hand over to you and say, please tell us about the structured notes that we've currently invested in, and what do we need to know?
All right, excellent. Andrew, thank you. Thank you, Paulo. I'm going to share the screen if that's good.
Yep, please.
Excellent. And PowerPoint. There we go. So thank you very much for inviting us in. We love chatting to you and the audience. Make sure that everybody's up to date. As you said, communication's everything. And hopefully we can get a regular cadence on this. So we're keen to do the update, on where we're at. Just as a reminder, Cashbox Global is a financial services organization. We registered in Mauritius under their stringent FSC license. We also regulated the South African FSC as well, because we live and reside and work here. So everything we do is in the space of education. We set out to design and to provide access to these contracts called structured notes for a global community. We're not in the space of advice. Happy to chat to your advisors if they like, but we would never understand and have access to your particular financial situation. So advice we can't offer and don't offer. So this particular presentation, again, is for your information and education. If you'd like anything more, we can gladly get together if required, or potentially then through your Wealth Migrate consultant. So I thought, Scott, just to give everybody just a quick reminder of what it is that we do and how it works, because that would then tell us how we're doing in our current products and how they are working. So as everybody remembers, we facilitate defined returns The bank is looking to attract large sums of money. We have investors and groups that have these large sums of money. How do we put these two together? And how do we create a contract together that the bank then defines how much they're going to pay us? So we're not in the space of just doing a 1-year fixed deposit because you're going to get 2, 3, or 4% per annum. We're in the space of upsizing this, and how does the bank do this, and how do we do this together with them? So we're now looking to create contracts that give above average returns, but very deep levels of capital and income protection, and to try and create these flows even in flat and declining markets. So what's amazing is this has been possible for decades. And what we've simply done, we haven't created anything new. We've just created access in moving everybody from a retail level where we get very little above business banking into investment grade banks. And investment grade banks are where financial instruments are created. And if we can go directly to source, if we can go right up the mountain to where the water is fresh, it's clean, there's no mud, how do we get into this level? We get into this level by invitation. We get into this level through higher capital sums. And we certainly get here by access to understanding and knowledge. And this is where Andrew, who I hope will join us shortly, plays and has been playing for the last few decades at this particular level. So we're going to go from very little returns up to 12, 14% per annum at this space. Why? Because that level of banking wants to package and underwrite products that they can leverage to create further returns for themselves. And how do they do this? It's by you and I changing the whole way we look at things and saying, okay, let's loan money to the bank for a change. Let the bank then create the returns and pay us back, but by contract. So what goes into a contract? Typically, the bank's going to look to put 3 or 4 stocks into a particular structured note. We don't need these particular shares to shoot the lights out. We're looking for strong, steady-based indices and or particular shares that the bank want to have brought back into their business and own within about a year, year and a half. They're going to try and buy these today at today's value, seeing a potential growth in the future, pardon me, in order to access from them. Hey, Andrew. So these banks are then going to issue these contracts called structured notes. They're going to define the returns under which they're going to pay, and we'll have a look at how these are working in a second. They're going to use the investors' deposits in order to buy options on these particular shares and underlying stocks. Now, we don't have to get involved in any of this. The bank's doing all of this. This is their investment team that are doing this to generate a return for the bank and for ourselves. We just got to understand how this thing is working, that we're comfortable to loan them the money to go and do this with. So the returns typically pay out on a quarterly basis, or if you take a growth-based structured note, which we don't have in our basket at the moment, or in this particular group, we're looking at a defined payment date, defined by contract. Once these shares reach a particular level where the bank is going to realize their potential profit, they're going to close this out. It's called an auto call, automatically call it back. The bank's going to profit. Its profit is more than enough to cover the cost of capital they're loaning the money from us at. So if, for example, it's a 14% per annum that the bank's paying us, they're that confident that their product is going to generate more than that for them, obviously, in order to go into this contract with us. So we work in a highly, highly regulated space. Cashbox, together with our structuring partner, looks at what is appropriate in the market now and for the coming year to 2 years. This is really Andrew's area of expertise. And we say, okay, as you know, things move in cycles. Now we're in a cycle of very high interest rates. What has that meant for the market, and what sectors of the market benefit from high interest rates? That's what we had to look at a year ago. Now, Andrew's going to take us through the opportunities that exist as interest rates start to come down, because we are hoping that by September, The states are going to put their first interest rate reduction in. Now, what's going to benefit? Because that speaks to our next notes. And we have a new note launching early August. We then create the product for our investor group, Wealth Migrate being a strong investor. Thank you, Scott and the team. You guys come in as one individual company. You go through an investment platform and directly into the bank. So no funds ever flow through Cashbox Global. All the funds flow via the investor and investor companies into the trading account and into the bank. And then again, the reverse flow as well on a defined date, which is incredible. Everybody in this space is highly regulated in order to make sure that our investments are safe. Scott, maybe this would be of interest to you. We've just gone back and had a look at our track record. We are busy with our half-year strat. We're going to get together next week. We've created 80 structured notes from 2020 to 24. So this is 4.5 years. 20, 21, 22, 23, 24. I have to use my hands. Nearly 5 years. 80, 35 have matured over that time, and you'll be surprised between both income and growth. We've returned 17% in USD, 18% in GBP, and 14% in Euro in those that have matured. 45 are still running, and of which 6 are in what's called the memory feature. This is a protective feature. One of the Wealth Migrate notes are in this particular space. So we're very proud of this record. And what's incredible is we don't need strong growth in order to create these returns. The bank's creating a leveraged upside return for us in this space. So if we have a quick look, Scott and the team, 6 structured notes have been issued over the period with yourselves. 3 have matured already, which case all the capital would have come back into the trading accounts and distributed, I'm sure. And 3 are still active. So thank you for that. Let's go into the 3 that are still active and how they're doing. The first one is BBVA Cars. This was a note that was based particularly around the excitement around electric vehicles and some of the biggest players that are in this space. So this started in May 21. This is what's called a conditional income, meaning that the underlying shares, we never own the shares, but this is what the contract looks to. It says as long as those shares are at or above a particular level, the income will flow. So this one's doing really well. This has paid out 42% since inception. So this is doing just as we needed. The next one down is the BBVA e-commerce. This started in September 22. This is fixed income. The difference between conditional and fixed pays out no matter where the underlying shares are, but it will pay out a slightly reduced rate compared to a conditional income. This is also doing very well. This has paid out 20.3% return since inception. The one that we're going to spend some time on is the BNP US equity share structured note.
Chad, sorry, just before we go to the PayPal BNP one, when you say 42%, I just want to put this in layman's terms for people. If I put $100 in, does that mean I'll be paid out $42 in income based on the fact I put $100 in? I just want to be clear on what 42 and 20.3 means for people.
So as the coupons afloat, we've added it up. You would have got 42% out in total over that period of time.
That's what I mean. So I put in $100 and I've so far received $42 back.
Yeah, excellent. So on the BNP US equity, the one below, number 3, we have a conditional income. You'll remember we need to get over this income trigger. And the income trigger, I'm going to take you into a graph now just to remind everybody, says that the shares can have dropped by 25% to 75% of their start price, and the income will still flow. We have one share in this basket called PayPal, which has taken a knock. It's at $62 a share now. It needs to be at $89 a share, which is 75% of its start price, in order for all this conditional income to flow. Now, what's affected PayPal over the last year, and Andrew will take us, or not last year, but since inception, as interest rates have climbed, and the reason for pushing up the interest rates was to quell the amount of spend and push down and contain inflation in the States, particularly and around Europe. As those interest rates have come down, spending has come down. Spending has come down, has pushed and put all the payment gateways, PayPal, Etsy, etc., under pressure, and has pushed these share prices down. So why we are so excited about the interest rates getting loosened, hopefully from September, and we drop the interest rates. Hopefully, we would then start to see spend come back in here. So this one, sadly, has produced no conditional income just yet because PayPal has been below the minimum threshold. It had dropped by more than 25% from when it started, which is really disappointing because it's not what we had seen. It's not what the banks had seen. But because we've got the memory feature built in, what it's happening is these coupons are getting held in retention. There's 38%, Scott, held by the bank waiting for this particular share to get above. So if we have a look at the balance of the underlyings in this basket, they're well above their trigger. In fact, they've all grown. This should close out. So I'm just going to take us back just as a reminder. We go through and we monitor the product every quarter. Here's the back of the fact sheet. So you'll see here is the 1st of July, 2024. We're looking for the profit trigger. We have to be above 75%, all 4 shares, in order for the payment to come out. Now, unfortunately, PayPal is below this. So the coupons are not lost. The coupons are put in hold. And as soon as we can get back over this income trigger, this income level of 75%, all the payments will flow and we're back in the clear. So what we really wanted to chat to Andrew about in a few minutes now is, what does the world look like going forward, and what's the chance of us getting back into this particular position? Our capital protection is built in, as you know, 65%. We still have way until the 6th of April in order for the shares to get over 75%. The income protection area at 65% on the right-hand side says to us, even if the shares are at or below their start price, as long as they're above 65% of their start price, we'll get our full capital out. What we ideally want to do is get our cash out as this PayPal gets above 75% of its start price, and then ideally back over its start price, because it will call out early, will auto call, and the product will close out. All of this is in the fact sheet. BNP Paribas, really large European bank, as we know, are good for this. They're holding on to all the stuff. They're honoring the contract. AMD has grown like crazy. NVIDIA has grown like crazy. PayPal is the only share that's holding us back here. But let's have a chat to Andrew and see where we are. I hope that helps frame where we are. So of the 6 products we've created together, there's only this one, with PayPal being the only share that's holding us back. So maybe over to you, Andrew.
And so, sorry, just before we go to Andrew, could we just go back to slide 8, if you don't mind? I think it was 8.
Sure.
No, sorry, the one with PayPal on it. It must have been slide 9, where you basically had the prices. I just want to see with the 65%. Sorry, which slide was that? There one.
Yeah.
No.
Yep.
Sorry, the other one. The one where you had the 62. So I just go up quickly, Chad, if you don't mind. That one there. So it's currently at 62. Okay. So what would 65% effectively be in terms of that capital protection?
Perfect. So what I'll do is I'll go back to the original share price start.
Yeah.
And we can work that out.
It's just an interesting almost scenario planning between now and April, depending on what Andrew says. Because as I see it, there's 3 scenarios, unless I'm missing something. Worst case scenario, PayPal doesn't get above 65% and you can lose some of your capital. Second case scenario, it gets above 65% but below 75%, and so you get your capital back but not the income. And if you get 75% and above, then you get your capital plus the income. Please tell me if I'm in layman's terms, if I've understood this.
You are spot on. So if you're over here, you're in the money, right?
Yeah.
But above 75 and 100. But ideally, what we want to do is auto call, where PayPal is above its start price. That would be ideal, because then we'll come out earlier and then we can go into a new product, given where the market's at. But what I'll do is I'll go back to the strike price quickly, unless you have it on hand, Andrew, and then I can work out that number for you.
Not at the moment, Chad.
Yeah,
Maybe
I'll get it for you. I'll get it for you. Great.
Could I suggest,
So,
Chad, just with your permission, just before we kind of pivot to the kind of the future, or is Andrew going to speak just specifically about PayPal? I'd just like to answer, like as an example, Jürgen's question around the fact that it's been performing, but the money is not showing in the Lemonway wallet. I need your guidance as to, should Andrew go first and I deal with that second, or vice versa?
I'm happy you drop these in as we go. I think where Andrew's going to take us through is, obviously PayPal's hit its headwinds. He'll give us where we're at.
Well, let's do that. Let's stick on the PayPal thing, because that answers that question.
Good. Thanks, Jürgen.
Thanks, guys. It's been a long time since I've spoken to some of you and seen some of you. It was good. Yeah, thanks, Chad. There's so much noise at the moment around what markets are doing and what interest rates are doing, and elections that are going on, and the war in Europe, and those all generally add up to headwinds in terms of what equity markets experience. In some instances, tailwinds. So, by way of illustration, as Chad mentioned, we're going through two cycles at the moment. The first cycle was the interest rate tightening cycle, where global interest rates were tightened. The handbrake was pulled up to stop overheated growth. And I'll address PayPal specifically, because I see that really as the only problematic scenario in the three notes that are running through the Wealth Migrate investor platform. But interest rates, they've pretty much topped out. I think there's consensus that they topped out towards the end of last year, and they've been put on the so-called pause for now 6-7 months. And there's this chomping at the bit, or champing at the bit, that interest rates get reduced. Banks, funnily enough, generally sometimes thrive in these circumstances, because obviously we're paying more for our debt, whether it be credit cards, mortgages, credit, you name it, home loans, etc. So banks' margins generally do quite well, and if some of the notes that we've put out during this time aligned with that theme. As Chad mentioned, one of the areas that does get impacted is discretionary spending, and PayPal, like many other vendor markets and conduits, has taken quite a hit to its earnings. And obviously earnings relate through revenue and ultimately through to profits. So profits have been under stress, not just because of a lack of spending, but in the PayPal scenario, there's always been it, but it's been massively impacted, because there's just so much competition in that sector. Probably its biggest competitors like Apple Pay, Google Pay, Stripe, Square, etc. Then you've got the banks climbing in with MasterCard and Visa. You've got all sorts of different options. So it's still the largest payment settlement conduit globally. I mean, it's got hundreds of millions of subscribers, but it has been impacted by competition. So that obviously means margins are squeezed on that side. But generally speaking, its biggest problem has been interest rates, which have caused people to close the wallets and say, let's just see how long these interest rates stay at high levels, because I can't really go out and buy a new set of golf clubs or a golf caddy or whatever it might be, when I need to pay school fees and energy and food, etc., etc. So there's been a great focus on interest rates. I think there was a lot of over-optimism in the States primarily. Towards the end of last year, we just hit the plateau, and they were already talking about, could they factor in rate decreases from March this year? And clearly, as the announcements have come through, as the Federal Reserve, which basically formulates interest rate policy in the States, as that's come through, it's been absorbed by the market. The interesting thing now is that the States is pretty transparent. They obviously interview, for example, the head of the Federal Reserve, Jerome Powell, and then they release the minutes, which is actually the minutes of the actual meeting. So we can see who's dissenting, and you can almost feel the intention of where the next movement is going. The sentiment comes through, which is often, it's an intangible. And what clearly is now coming through is that there's been quite hawkish, in other words, quite aggressive, like we're not going to release interest rates until we're absolutely convinced that we're on the right track here to reduce inflation down to the target of 2%. And they rely on a lot of data. The states, like most central governments, are very data sensitive and data centric in terms of they look at employment payrolls, they look at new housing build approvals, they're looking at employment stats, they're looking at farm payrolls, they're looking at consumer sentiments, all sorts of metrics. And a couple have gone the wrong way. Instead of going down, they've remained sticky, and that's a word that's been used very, very often. So it's been a slow process in the States of interest rates coming down. We've seen a cut in the European sector, and probably the UK will probably outpace the States as well in terms of getting its first rate cut through. Fact of the matter is, the Federal Reserve is supposedly apolitical, but we all know there's a huge election going on in the States at the moment, with all its shenanigans and sort of showmanship that goes with an American election. So there is that overbearing sort of situation. Long story short, from the minutes of the last meeting that came out, it seems apparent now that there seems to be a consensus that there's agreement that there could very well be, and I think Chad did mention it in September. They're sort of pricing in now into the market that there could be a 0.25% basis, 25%, 25 basis points, 0.25% reduction, which will be great for those interest sensitive sectors. So, for example, discretionary spending. If you want to talk about energy, solar, it's expensive to go and put new solar panels, convert to wind power, green energy, et cetera, So those sort of sectors are very interest rate sensitive from a negative perspective. We've seen in many industries how order books have just dried up. So therefore, they're not going to be calling on the suppliers of the commodities to build those. There's a knock-on effect. But generally, interest rate sensitive sectors get hurt very, very quickly. There's often a knee-jerk reaction. There's more volatility. In the PayPal sector, as I mentioned, consumers have pulled in their belts, sort of winding their heads, and they're not willy-nilly running around spending. But this is going to be a sign that we are now approaching the second cycle. We've been in the tightening cycle, and it's like any economic 101. You've gone from expansion to contraction. We need to come out of that contraction, and the governments around the world have to walk a very careful line in terms of not having those rates too long for too high, because obviously you then start getting distressed consumers, you get distressed deals, and basically you then slip into the recession. I think globally, the way that rates have been applied, worldwide, is that we have seen pretty much everybody has avoided a recession, a hard landing recession, and it's into sort of lower growth, lower earnings, but we've missed, we can take that recession word away at the moment. There is pent up enthusiasm, I believe, to spend. If you look at the forecasts from a lot of the other sectors where PayPal would be reliant on. So, if you look at sports goods, if you look at the likes of Adidas, Nike, Puma, et cetera, the big sporting companies, their earnings have been hurt. Now, most of them are aligned to online, online saving. The world has moved from sort of bricks to clicks, if I could call it that. We still have a high street marketplace, but believe you me, online sales have just gone, exponential. So that's where these payment facilitators, like a PayPal, go. PayPal itself just, so that's the macros. From inside, it had its own problems, pretty much going back 4 years. Primarily into the management structure, where their incumbent CEO at the time was he announced his intention to resign, but he stayed on and they couldn't find a suitable replacement. Their CFO left, so it was a bit of a rudderless ship for a moment. With all this competition snapping at its heels, it lost market share. I'm happy to say that the ex-CFO of Intuit is now the CEO. He's been there 18 months. They've gone through a lot of cost savings, cost analysis, headcount reduction. They've done all the things that a corporate will do when its margins are squeezed. They've undertaken quite a lot of intuitive and I think innovative alliances and collaborations. I think that was the one word that came out of COVID, where you would collaborate as opposed to compete with each other. But the market is a little wary still of PayPal in terms of it's this giant super tanker. It's not a ski boat that can turn around on its head immediately. It's going to take a little bit more time. Now, as Chad said, we've got another 9 observations. I beg your pardon, we've got 7 observations left. 9 have been completed. So 7 observations is just short of 2 years, because you have 8 observations, that's 8 quarters. So we've got some time. This finally matures on the 30th of March 2026. That would be its final term date. That's per the contract. It's a 4-year date. And we've got that period of time, hopefully sooner than later, for the earnings and the revisions to come through. PayPal, interestingly enough, and this is what makes it a little bit frustrating for myself, is that it's actually, in terms of its earnings, its performances, its quarterly earnings announcements, is actually doing quite well. But it seems to just be out of favor, if I can call it that. I think there's a loss of not understanding, but there's probably a loss of respect for the business, because it has gone through this rather large behemoth type business, and it's just carried on. It's got a lot of activist investors who are jumping up and down. It's certainly in the position, with, I think at last count, over 200 million account holders, to do a lot better. Now, PayPal's is not trying to take out the opposition. It's got quite an interesting strategy. It's not actively looking to attract more investors, or bigger, but not investors, but more account holders. But it's trying to deepen the relationships, deepening the experience on the wallet with that particular client. So the add-on services. So that's where that's their new strategy, which is not just simply, well, we bought on 10 and we lost 3, so we net 7. That's great. They're saying, let's keep those 10. They know how we work. We know what they want. Let's make the relationship deeper. So it's all about knowing your client, what your client wants, and providing it. So yes, whilst we've got the clock ticking, because every single note has a contract period and that clock is ticking, every quarter, we are watching it. We report. We give an observation report quarterly, which I know we send through to the team for distribution to yourselves. And it generally picks up what has happened in terms of what are the earnings, how do they come out, what's the announcements, is there anything on the horizon. And certainly, I think the interest rate is not a silver bullet that's going to get us out of the mire completely, but it's going to be a major motivator of moving those sectors that are very interest rate reliant. So I've always been positive about PayPal. It's a massive company. Fortune 500 S&P constituent for many, many years. It's a very solid company. I think it went through a phase where pretty much it lost its way. And I think now it's actually found its way, and it's coming back into an environment which is probably a little bit more opportune for it, as opposed to an interest rate that just gets ratcheted up every quarter. That's pretty much it from PayPal. I do quite a lot of in-depth, under the hood technical analysis on a quantitative basis for a number of clients. So if anybody would like that shared, it is quite technical in terms of price earnings ratios, net asset values, PEG ratios, you name it, all the technical stuff. But if anybody would like that, I'm happy to share that as well.
Awesome. Andrew, thanks very much. I think that's super valuable. If you don't mind, what I'd like to do now is pivot to Jürgen's question, and obviously the question a lot of people want the answers to. And I think this is just from Paolo's perspective. Maybe Chad, if you wouldn't mind just stopping sharing so I can they can see me better. Yeah, look, I think one of the challenges we've had over the last 12 months is that we changed the custodian on the 16th of October last year. Paolo joined us and also got us our juristic rep under the FCA in England. And the challenge was what was perceived as a fairly easy thing to sort of take over has not been easy at any measure. Firstly, and you know, this was with regards to all of the different investments that the Wealth Migrate investors have made, me included. And what we found was when Paulo first joined, he was like, look, this should take sort of 3 months to get everything up to date and kind of get everything moved across. And unfortunately, it's been a hell of a lot more difficult and a hell of a lot more complicated than expected, with very little handover. So as an example, with regards to these structured notes, you know, we were using Ramsey Crookall. So you have to use a licensed broker. And the first major challenge we had was actually getting Ramsey Crookall to agree to the new compliance regime. So if anyone's ever dealt in the compliance space, I wish you could say that it works in days and weeks. I'm sure Chad and Andrew would back me up here that this stuff happens in months and quarters and sometimes even years in terms of the process, because they are protecting people's money and they are protecting their own reputations and their own licenses. So that in itself took a huge amount of time. Then we had to update and get all the KYC, KYB stuff done. So know your client, know your business between Lemonway, because Ramsey Crookall had to be updated. And that in itself was another huge administrative nightmare. And I want to be very clear here. I know investors don't care. There's only two things investors want. They want their dividends and they want communication. And I fully acknowledge and respect that. But if we don't explain what happened and why it happened and what we're doing to fix it, then there's no way of most importantly explaining what's been done to fix it. And then to your point, Chad, one of the structured notes exited and the money was in Ramsey Crookall. And so I know that Paulo even worked with the previous custodian to try get all this stuff done and to move that money, only to find out that there were two other structured notes. Incomes were not included in that wallet, if you want to call it that, in the Ramsey Crookall wallet. So then it became a case of, which by the way, again, unfortunately there was no handover to this. So it's been an investigative process through. And then it was a case of, okay, well, now we've got these other Ramsey Crookall wallets. We need to go through the same process to move this money over to Lemonway. And that has taken a hell of a lot longer than we would have liked. And unfortunately for us, just as a team, we're a very small team. And I wish I could say it was just that we're dealing with the Ramsey Crookall or whatever. But obviously with regards to the deals, we had to do this on every single deal. So it's been a bit of a firefight on every single deal to get the payment gateways working again, to get them back into the Lemonway wallets, to get the distributions happening. So what we focused on to start off with was all the money that was in the Lemonway wallets to get that distributed to people's wallets. And then it's been a bit of a firefight to try and get all the other deals that weren't like where the sponsor, as in this case, it's Ramsey Crookall, was receiving the money and we had to get into the Lemonway wallet. Again, the beauty for investors, it's, you know, there's always third-party payments. We can never touch people's money, so you know that peace of mind is in place. And then the last thing I'd say before I hand to you, Paulo, in terms of, you know, anything you want to add to that, plus how you see it going forward, was the final comment. The final thing for me, which is important, is that the deals that we've done since the new team started and all the deal pathways have all been set up, they're all up to date. So all the deals that have happened in the last 12 months are all up to date. The distributions are flowing. Everything's been paid. A deal that closed 2 months ago, the first dividend has in South Bend has just moved over. So all of them are paying and up to date. So unfortunately, it's been this game of the ones that Paulo has been involved in from beginning to end are all working and already working. It's been the ones in terms of the legacy where we've had to do this firefighting with very limited resources. And I know it sounds like excuses, but I'd rather just own the truth. Anyway, over to you, Paulo. You muted.
I'm sorry. I don't think I have a lot more to add, except Jurgens, I think a personal apology to you. I did speak to you, and was absolutely under the impression that we would have those funds done from Lemonway. Sorry, I beg your pardon, from Ramsey Crookall a couple of weeks ago, and I told you that it would be done by the end of the week. Well, it wasn't. But I think it is safe to say, and I am prepared to say to you that by next week, Friday, you will have those distributions in your wallet, Jurgens. So a personal apology on that. I think Scott's pretty much summed it up without going into the nitty-gritty further. I mean, we had a situation where Ramsey Crookall didn't even want to talk to me right from the start. And I think now they're really asking if we can do the next bit of business. So I think they have some faith in that we are handling things correctly as long as it is taken, but that I feel that they are confident that we can take things further to the extent where they've got a representative in South Africa, in Cape Town, and they've reached out to me to see, what else we can do together.
So, Paulo, just in terms of, because this has been one of our greatest challenges, and I struggle with this, where we give ourselves a deadline of next Friday. I'm just giving an example, but we can only, we're not as good as a third party that has to pay money, or if you've ever done international money movement, it has to clear, etc., etc. So what we're trying to do is our best always to give a guideline of timing, but equally acknowledging that we're only 100% in control once the money's in the Lemonway wallet. And my understanding of what you just said is the money is still moving from Ramsey Crookall to the Lemonway wallet. Is that correct?
Yep. Yeah, Scott, I think that there is a part that is that, but then there is a part also that it's me. And I need to get better at estimating those deadlines, because again, I sometimes I don't quite realize how long things are going to take, and the time required to follow up on multiple things at the same time does present a challenge. But I think we are getting to the point where I truly believe that we are getting better and will get better going forward.
And then in final clarity, we like I started off, Andrew, sorry, it was before you joined us, but ultimately what we'll do back to a weekly is we can update, look, money's moving, we expect it to land here, then we can do the distributions, etc. Because obviously this is ideally this is a quarter problem, and what I mean is that every quarter people are getting paid. So you want to be keeping people updated every quarter in terms of that. And obviously also, sorry, just quickly, but also Chad, with regards to, or Andrew, I think you mentioned, with regards to the deal reports, etc. This is all the consistency that, and I'll own it. Funny enough, listening to you, Andrew, talk about what happened in PayPal, it's like that sounds like deja vu of my last 18 months. So, but we've certainly got stability in the team now. And one of the things that also where the ball was dropped was your deal reports coming out should be being consistently shared every quarter so everyone understands what's happening. And, like I said to Paulo before this session started, we're only as strong as our partners, and Cashbox and your partners are very strong partners, and we want to continue to celebrate your success, which ultimately is our investors' success, So yeah, Jürgen, I hope that answers your question, and equally, in terms of, any concerns that you've got. And, our logic is we're trying to get this done as quickly as we possibly can, just reminding everyone that it's across all the deals that are performing, the legacy deals I'm talking about, to get them up to date. But the good news is these ones are performing, and let's all buy stuff on PayPal and get PayPal's share price up.
Good advice.
Anything else, guys? I know that Paulo had a hard stop that he needs to go to. Andrew, I'd love to kind of just get your comments on where the market's going to finish off. But is there anything else that anyone can ask or need help with regards to Paulo? And then Chad, myself, and Andrew can finish up.
Scott, I'm also happy for you to share my number in case anybody wants to reach out personally, and I will gladly address any individual queries.
Okay, no problem. I'll put that in the chat box. Thanks, Paulo. I think at the end of the day, the whole purpose of these things is, we're a human team with a human heart, and we really care about our investors. And it hasn't been an easy 18 months, and I'd rather just own the truth and explain what we're doing. We also are in the process of getting Paulo more hands, because one of the things we've struggled with, I don't want to sound arrogant, but I'm a pretty intelligent guy. And I'm like, Paulo, how can I help? What can I do here? But it's kind of regulated stuff. And I'm sure Chad will know what I'm talking about here if he was trying to help Andrew. There's a level of sophistication that you've got to have to be able to assist. And that's where it's been quite tough for me personally from the sideline, not being able to support my teammate, because I don't have the regulatory skills. And someone like Ramsey Crookall will only talk to the regulated person. They won't talk to me. And if you're chasing someone regularly to update, have you done your KYC? I know it sounds like excuses, but have you done it? Haven't you done it? Lemonway, have you done it? Haven't you done it? If you know Frenchman, nothing happens fast. So, I wish I could have been his little little terrier, you know, but they wouldn't let me. So, but anyway, I think he's got on the back of it now. The funds are flowing, and so it's a case of us just getting the job done now in terms of that process. Should we pivot back? I think we've probably covered that enough, and I'll be doing the weekly updates, and I've got the FAQ next Friday if anyone wants to ask any more questions. You know, I'm happy to answer anything, and Paulo is happy to share his mobile number, which I'll put in right now. So let's pivot back, Chad, and Jay's asked this question. Let's go back to my question around PayPal. I can see you've put it in the chat box there at 62 at present, but I'd love you just to kind of explain this. Oh, there, you've done it already. Fantastic. So the semantics of what that means.
Yeah, so Jay, thanks, and Scott, thanks for the question. I'll do this next time. So presently, PayPal is sitting at $62. Scott's given us all instructions to go and spend on PayPal because we need to push it back up. If we can get it to $89, or once it's at $89, we are in the money. All the coupons will flow, and we would get 100% of our capital out should it run to full term. Should it not get to full term, we need to be at $76 in order to get full capital out. So the contract says if, for example, it closes and let's say is at $62, we would get 62% of our capital out. Nobody wants this. We want to get our full capital back out. So I sense as the interest rates come down and spending goes up, the whole intention with pushing interest rates higher was to keep spending curtailed. This should start to pick up. And as Andrew said, PayPal, like a Visa, like a MasterCard, it's top of its business. It's run really well. This, and maybe Andrew can help us, is probably represented as a buyer at this level. So anyway, we need to get it over at 89, and then we're in the clear. So Jay, I hope those numbers help. So you want to write down the $76 and the $89 with the intention that we get to 89 or above.
And we've got until April next year, in simple terms.
April 26.
26.
Oh, wow, 26. Sorry, I read 25 on there.
It's just under 2 years.
No. Yeah, we got 2 years.
Yeah.
Okay, good. Okay. I'm getting older. That 5, 6 looked like a 5 to me.
Cool. Thanks, Jay. Good question.
Yeah, I think just to chip in there a little bit, you know, Chad said it's probably a buy at this rate. So this is a great time to buy PayPal in terms of its actual metrics. It's had a solid couple of quarters now in terms of its earnings. If one looks at the Wall Street analysts, so there's about 34 Wall Street analysts, the major companies who do analysis day in, day out. They have teams of guys in suits doing this stuff, very bright, clever people. And at the moment, there's a consensual rating of it's a strong buy, given it's sorted out its issues, it's got team stability, it's got focus now, it's got the right incumbents, you know, driving the ship now. And if one looks at its competition, the metrics actually point to that valuation, that it is undervalued. So, you know, yeah, whilst we went in at a higher price, somebody going in now for a long-term value hold, it's a really good pick. You know, I can go through its price earnings ratios against its peers. I can go through its sales ratios. Everything points to the fact that it is a buy. As I said, it's been rather unloved because I think it had this sort of albatross flying above it, doing its proverbial on its head, because it had suffered this malaise of not reappointing a new CEO, bringing in the new broom, getting going. And it's a big ship to turn around. And they decided not to turn around, but to rather power it up by doing these new sort of intuitive, innovative strategies of deepening the wallet as opposed to just getting more people on board and hemorrhaging out the back door at the same time. So as a buy pick, I'm not suggesting you go and buy it, but certainly what the analysts are saying is that it presents itself as a worthwhile, you know, value play. Now, a value play is something that you put into your portfolio, and over time, it incrementally gives you good, solid growth. It's a strategy that Warren Buffett uses in South Africa, the Alan Gray Group. It's a value strategy. Buy it now, hold it, and you'll unlock the rewards. Now, if we had April next year, I'd be a lot more nervous. So I wanted to jump in earlier and say, Scott, you've got another year on this. But as Chad says,
I must admit that makes me more relieved, because when I was sitting listening, I was like, okay, this is gonna be tight. But anyway, that's very relieving.
And I really don't want to be in this position in a year's time having the same conversation, because then we're just accelerating into the consciousness that you thought you were in. So it all points that the analysts are enjoying what they're seeing. The earnings are coming through. Obviously, what they need to do is that people start buying the actual stock, because obviously they're basing that on earnings that are going to come through and profits that come through after gross. So it's looking as though, conceptually the landscape looks as though it's in a much better, it's calmer waters. And as you say, maybe a bit like yourselves, you can see the direction it's going in, and we've got some time in which to turn it around. Now, as Chad said, it's great if we get to that 60 whatever dollars is, the 65%. But to me, this has now become almost like a growth stock, where we want to unlock that accumulated coupon, which every quarter it just goes into memory and accumulates like a snowball, getting bigger and bigger. I want the snowball, and I want it in an ice cream cone, and I want to give it back to all the investors. Just to give you some idea, this was Cashbox's, I don't know if we've done any bigger ones since, Chad, but it was one of our biggest raises in the 4-year period, in that period that Chad highlighted, the 20 to 24. It was one of our biggest raises. So we've spent a lot of time talking about this. I spent a lot of time talking to other banks who do analysis. So, for example, Goldman Sachs, Nomura, Rothschilds. I'll say, what's your opinion of PayPal? Not just talking to the analysts, because the analysts obviously see it from a different perspective. So we're doing a lot of work on it. It's not simply a case that we've got the contract, we're in it. We're also seeing, are there gaps would there ever be an opportunity for us to have an exit strategy from a note? Because a note is a contract, so you'd be breaking the contract. I'm not saying contracts should be broken, but sometimes they may present themselves an opportunity. I mean, just take, for example, if we went to BNP and said to them, we'd like to actually exit the strategy. We'd actually like to exit the note. Their own qualitative and quantitative analysts will say, wow, it's built up a 38 or 42% return in memory. We can get that. And if they exit, and we can exercise the option on the shares as and when it gets to term. So the banks can actually do this. It's a strategy we don't direct. But I think if we got to the absolute point of almost no return, let's say we were 6 months away, it'd be a conversation that I would probably take up with the structurers and the bank themselves, the dealing desk and credit, because this is a structured note is a debt issuance off the balance sheet of the bank. In this case, BNP has issued it off their balance sheet. So all these type of issuances have to have the approval of the credit committee, the investment committee. And I've always said banks are absolute non-charities. They're in it for how much money they can make. And if they could see an opportunity to pick up our accumulated coupon and pay us back our capital and exercise the option, would be happy days for them. But I don't want to give them that opportunity, because I do believe that the good ship PayPal is actually pointing in the right direction. You just got to have a little bit of patience and watch it closely.
Awesome. Final comments, Andrew, in terms of just generally, what you guys see coming down the pipe, in terms of, some structured notes. We've got a lot of demand at the moment from people in terms of different opportunities, and one of them being structured notes. So, I'd love to kind of get going again with new structured notes. But yeah, what do you see coming down over the next 3 to 6 months?
Yeah, so we've been very thematically orientated, Scott. In other words, we've tried to follow the trends that are prevalent and prevailing, both from a longer term perspective, and also, as you say, maybe a 3 to 6 months, like what's going to happen in the second half of 2024. It's worked successfully for us in terms of following the trends, trying to find the correct companies within that trend. So whether it be clean energy or electric vehicles or miners or banks, you name it, we've looked at them. Sometimes we've discarded them. Sometimes the banks haven't had the appetite to go in. But from a thematic success perspective, it's worked very well. So with the, obviously, let's just take a step backwards. Looking at interest rates, let's not talk about what was, because that was where banks did very well. We're looking now towards, if interest rates do come down, what industries, what sectors, which parts of the globe are going to do better than others. We've got a couple of anomalies floating around at the moment, and the headwinds you can't discount them. So whether these regional conflicts actually go much bigger in Eastern Europe and the Middle East, that could be a big problem for equity markets. And when one talks about going nuclear or a widening landscape of conflict, then people start looking for risk-off type of assets. Equities don't always present the best opportunities there. A lot of people saying, oh, we should be investing in jet fighters, and people make boots and weapons and et cetera, et cetera. That premium's been discounted because it's been priced in already. If you look at the share prices of the major suppliers to the American military industrial complex, those prices have all gone up, and they've gone kind of sideways now. It's too pricey to get into them. So we're still looking for value opportunities. But as Chad said, in a structured note, we don't need the thing to go exponential. We just need to hold its value. And as long as it works within those different strata of the triggers, we're very happy. From a global perspective, it's been a complete year of change. I think the second half of the year we've seen, I think it's almost like the Arab Spring, which we had a few years ago. We've seen changes in government and this whole coalition thing coming through in India. We've had elections in France, which have really shaken up that part of the world. The UK has changed government with a landslide. It's probably going to, at this rate, be something replicated in the States. So what will that do? Because the States have said they're going to be very isolationist, make America great, let's concentrate on China, and Europe can sort out the Russian problem. Almost isolationist. So what would that mean? A lot of talk about trade and what the second biggest economy, if we can still believe it, is China has shown very, very muted demand, whether it be for a new Rolls-Royce or a Patek Philippe watch or whatever, a lot of demand from China has disappeared. And that's affected a lot of businesses. Literally, as I mentioned, from the luxury side right through to staples and commodities. So what would happen in the instance of America becoming, revising its policy in terms of, right, we're going to slap on tariffs on everything that anybody who supplies to China. It happened last night. One of the biggest, what's called wafer companies, they produce the actual basis for these semiconductors and microprocessors, a Dutch company called ASML in the Netherlands, been absolutely stunning in terms of its last 5 to 10 years performance. We've made a lot of money in it. It's been slapped with, it provides chips all over the place. And the US government says, right, anything that comes out of ASML is going to have a 25% tariff locked on it. Same for electric vehicle. All the Chinese guys want to dump their cheap cars in America. Tesla's jumping up and down and saying, and GM and Ford and Chrysler, what's not called Chrysler anymore, they're all saying, well, you need to slap on bigger tariffs. So these are becoming electioneering issues now. So the Republicans, Democrats saying, right, if we're elected, we're going to slap on 100%, tariffs onto Chinese vehicles, onto NIOs and BYDs, etc. So it's a lot of posturing going on. There's a heck of a lot of noise. Chad and I were talking about it. There's a lot of negativity that, world equity markets are going to collapse. The financial system is going to collapse. People have been saying that for absolute donkey's years. And maybe it is a conspiracy where all the world's global leaders and central banks have this giant Ponzi scheme out there. And we just unwilling or unknowing participants in it. But the fact of the matter is that very much like an American election, you've got to stay the course to a degree. You've got to see where your own portfolio is being impacted or could be affected, and take some action. Again, it's the whole diversification. It's like your marketplace, Scott. Have different streams of income coming from different asset classes at different times with different payoffs in different currencies. So that's what we've tried to do. We've tried to diversify across issuing banks, different banks we get involved with. We have different currencies, we have different themes, We have different payoffs, income, fixed income, defensive. We have a capital guaranteed, complete 100% available. So it's a case of mixing and matching what meets your requirements, because it is very complicated out there. It's very noisy. I think that if interest rates in the States do come down, I think you're going to see a lot of broader growth in America, for example. This year, it's been the Magnificent Seven. It's been tech that's driven a lot. It's been slightly wider than the 21 recovery, but there are other industries that are offering great value. You just have to look at Warren Buffett's picks in terms of what he's putting in and out of his portfolio, and he does a lot of. He's a great value investor. But again, on the one hand, he'll invest in renewables, and on the other hand, he goes and buys Occidental, which is, it's a hydrocarbon company, sucks out oil and packs petrol. So he bets black and red. So yeah, I think there's going to be a lot of opportunities. A lot of people are waiting for, the market is waiting for some relief. It started happening in Europe a little bit. You're probably going to see the European interest rates come down faster than the Americans over time. So again, we're looking at a lot of European-based companies where most of the earnings are generated, let's say perhaps in euros, as opposed to companies that are just generating it and reporting it in USD. That's a whole other discussion, in terms of what James Painter and the guys say in terms of what's going to happen to the US dollar. Another discussion is, what's the future of digital assets? It's been very, very interesting to watch the growth and development of the spot, the EFTs in terms of cryptos, how much money actually flowed into those those traded funds, absolutely enormous amounts. And I think, the guardrails that are being put onto that industry are going to be absolutely worthwhile for that as an asset class, because it's become an asset class now. People trade it as an asset class. So lots happening. I think there's lots of opportunity. Our mantra is build portfolios, build them carefully, and have that diversification. Because if somebody presses a big red button in Moscow, it doesn't really matter where your money's going to be. We might as well go back to growing vegetables in our back gardens, because it's going to go back to the barter system. But we've got to live in the moment. We've got to live in the present and take as much advantage of those good opportunities.
Awesome. Well, I deeply appreciate your time, Andrew and Chad. Chad, as always, thanks for being so thorough and professional. Andrew, I love the insights in terms of where you see the world going. The word that resonates most for me, and most people know that I highly respect Ray Dalio as well, and it's just that diversification. Even if you look at Chad and the results, I think it was 80 odd structured notes and 6 aren't performing. If you put all your money in one and it happened to be one of those 6, then that's not a great thing. But if you put a little bit into 80 of them, then it's not even 10%. Just to give people perspective on it. And so it's just kind of the way I look at these things. But thanks for your guys' time. I deeply appreciate it. To Jürgen and all the investors, you can trust me that we are doing everything we possibly can to get this money into wallets, and let's not only get these current deals and PayPal up to date, but hopefully more deals with Cashbox in the future.
Cool. Thank you, Scott.
Awesome. Thanks, everyone. Cheers. Bye then.
Thanks, everyone.
Cheers.
Good one.